Okay, so let's get started here, Matt. First of all, wanted to thank you for coming out and for participating in this webinar with myself and with Matt.
One.
There we go, Matt. Say good morning again. Good
Good
afternoon,
morning.
whatever it is.
Afternoon.
Well, cool. We're really excited to have you here, and this is going to be about an hour long, start to finish. We hope that you'll understand more about the current market, where things are, what you can expect when you are a first-time home buyer. And ultimately, at the end of the day, we just want to add knowledge. We want to help you feel more comfortable doing something, taking a step that can seem a little bit daunting. So without further ado, I am Bryce Sketzlar, branch manager over at Mortgage One, and I have with me Matt O'Brien, fantastic realtor, very, very talented, doing a lot of business here in San Diego, so he knows the market incredibly well with Realty One Group. To get started, wanted to talk about how one of the big misconceptions that folks have right now, which is that interest rates are too high. They're too high to be able to buy, and it's better to just wait until they come back down. When the reality is that interest rates are still at a very, very low level when you look at the grand scheme of things. Over the last 30 to 50 years, there has really been only a couple times, really the last couple years, where interest rates were lower than where they are today. So we're going to talk about that a little bit further, a little bit more in depth. Also wanted to mention that no matter if you buy right now and you lock in an interest rate today, there's always the possibility to refinance when rates come back down. The market is cyclical. It tends to go up. It tends to come down. And so we can take advantage of dips in the market to maybe get you a better interest rate. But if home prices keep going up, you can't refinance the home price, right? the prices go up and you're locked in wherever you buy. And then lastly, wanted to comment about how the whole impetus behind this, which is interest rates are going up because the market, the economy in the whole is very good right now. Wages are increasing, unemployment is extremely, extremely low, and home prices and interest rates are kind of reacting to that. So a lot of really positive things going on in the market, and at the end of the day, it probably means that if you're making more money in your job, you can afford to make a little bit more, in terms of your mortgage payment too. What I mentioned earlier with interest rates being really at historically low levels is kind of driven home with this graph where you can see, let me grab my pointer, you can see that back in the early 80s, interest rates were literally 3 to 4 times what they are today. 3 to 4 times, not 3 to 4 percentage points higher, 3 to 4 times what they are today, maxing out at, the 17, 18% range. Whereas now,
I love watching that trailer. Anyway. Oh, Bryce, we can't hear you. Bear with us a bit, everyone. I'm having troubles hearing Bryce. Hopefully you can. There we go. All right, Bryce, you there? Wonderful thing of going live. You guys please bear with us on this. All right. Nope. Okay.
How about now?
Awesome.
Okay, cool.
Welcome back.
Sorry about that. We're live. We're live again. Okay, what I was saying is that interest rates have literally come down over the last, 30 to 40 years, where in the early 80s, we were in the high teens. Today, we're boom, all the way down here, right around 5%. So people mentioning that interest rates are higher than they've been. Sure, we've had this little increase right here, if you're looking at the graph. But overall, we're at an extremely, extremely low level when you look at the grand scheme of things. So, a lot of people, that's one of their, holdups, if you will, to buying a home right now. Oh, interest rates are high. Another thing that I hear is that maybe it's not a good time to buy. So, Matt, why would right now specifically in the year be a good time to buy? I always hear that spring is the best time to buy a home.
This is a great myth, and actually, this is a false answer. The spring, it's when a lot more buyers get into the market because it's tax time. School's ending. There's a lot of different situations that people start thinking about getting in the market around then. Plus, daylight saving time is back, right? So you have a little bit more time to get out and look at properties during the daytime. But actually, there's more buyers coming in the market in the spring and summer, and that actually hurts you because then you have more competition. You as a buyer, actually, this time of year is actually one of the better times of the year, just because of the facts I just said. So how is the market? Well, the market is up and down. It really depends. What is your motivation? As Bryce mentioned earlier, the rates are going up higher, still historically low, but in California, we're at 1 in 4 people can afford to buy a home. So that people that are able to buy are buying at the higher end. So that higher interest rate actually can put some people out of the market. If you're an owner occupant, most owner occupants, being your primary residence, most owner occupants tend to buy with their heart versus strictly the financial sense as an investor would. So the market is not really the best investor market. There's less properties coming on the market as foreclosures and short sales. And most sellers, unless they're in a desperate need to sell the property quickly for cash, aren't going to be selling to a flipper. So you as an owner occupant have a better opportunity in most cases to get your property over a flipper, which we were having a tough time with earlier this summer.
Yeah.
So I heard the market's going to crash. Well, I don't see
Chicken Little.
I don't see it crashing, and Bryce can attest to this. We don't have all those ninja loans, no income, no assets.
Absolutely.
We don't have all those high risk loans that are interest only, and when the interest that teaser period, if you will, and I'm sure Bryce can clarify this later, when that period's over, then you have to start paying higher interest rate if it is an adjustable interest rate, or if you have to start paying principal on top of the interest. And that's what hurt a lot of people when the market did crash, is sometimes their payments were doubling. So, if they didn't have the money to do that and they were gambling on the market increasing, everything, we just had a horrible trifecta of everything crashing. So I think the biggest things that would affect our current market are, if we have large industry here in San Diego disappearing, like close the military bases, or the biotech industry and stuff like that shuts down and goes out of state or to a different area, then we might have a lot of job loss in San Diego, which which would affect a crash. But again, a good thing for you as a buyer is if that happens and you're not in one of those industries, you have more properties to choose from and be actually a better situation as a buyer.
Yeah.
So Bryce, rent or buy, especially with all the stuff I just said there. I have a lot of clients say, well, gee, I think I'm just going to hold on rent and see what happens in the market. So I'm going to let you take this one from here, the pros and the cons. And
yeah. Thanks, Matt. And oops, I jumped one slide too far. I hear that basically question all the time where people are asking, hey, my rent is actually okay right now. If I were to go buy, I'd have to pay more money than what I'm paying with rent. So why would I do that? Right? I don't know. Do you ever hear that? Do you ever get that pushback?
Oh yeah. And that's why I love this next demonstration you're going to show. It's such a great tool and eye opener for people to see, okay, yeah, you're right. In the immediate future, it's not going to benefit me, but in the long term, well, I'll let you take it. Like I said, this is a great slide.
No, exactly right. And so what this slide actually shows is, hey, if you were to buy a $600,000 home here in San Diego, what would it cost, number one, to rent that home today? And then how would it look over a 9-year period, which is the average time that someone actually keeps a property? How do the numbers compare? Where is the benefit for someone buying a home? And so just going through the numbers pretty briefly here, renting a home that would sell for about $600,000, you could expect to rent it for a little under $2,800 a month, okay? Buying the same home with 10% down, so 10% of $600,000 would be $60,000. You'd have to pay principal and interest, property and taxes, property insurance and taxes, and then your total payment would come out to $3,374, a big chunk more per month, right? And so what I like, and Matt mentioned this just a moment ago, is that over time, the 30-year fixed rate stays the same. Conversely, over time, the rent payment goes up. So at the end of the 9-year period, you're paying more in rent than you're paying, what you would have paid with your mortgage payment. So cash flow, there's no doubt about it, you're coming out behind, right? At least on a monthly basis. If we take the difference over time, assuming that rents are increasing by their average about 3.3% per year, you come out behind. Now, the big benefit for buying a home are the couple things that we're going to talk about. So number one, appreciation gain. So that means that however much the home goes up in value, you get to keep that as basically your net worth. When you sell the property, boom, that appreciation is yours. You can pocket it. You can do whatever you want with it. That is literally your balance sheet increasing over time. And it's estimated that over the next 9 years, home values here in San Diego are going to go up by about 5% per year, which I think, Matt, correct me if I'm wrong here, but I think California over the last 80, 90 years has averaged about 8% per year, right?
Yes. Usually 7, 8, 9.
7, 8, 9. So 5% over the next 9 years is probably conservative, right? Could be conservative. But in this example, your home that you buy today for $600,000 is going to be worth $939,000, right? And this is just an estimate. Obviously, the market is going to do something different. It could be a little less, could be a little more, but that's still an extremely significant number, right? How long does it take you to save up $339,000 without real estate? And then over here, remember that you're paying down your mortgage rather than paying down your landlord's mortgage. You're paying down your mortgage. So over that 9-year period, you pay it down $89,000. Selling a home, you've got to pay real estate commissions and closing costs and stuff like that. So you're going to pay, roughly 56 grand to do that. You have a little bit of tax benefit. It's less than before, but you still have some tax benefit. And so the net, adding everything together, is $343,000 ahead, right? So if you were to rent for the next 9 years, zero. If you were to buy, $343,000. So huge difference, almost mind-blowing, right? It's hard to wrap your mind around such big numbers sometimes because it's just huge. It's astronomical compared to what it would be renting, right? Let me turn off my pointer here. So, talking about the finances is fun, but there's more to buying a home than just the financial part of it. Matt, what do you see as the biggest benefits to buying a home, and what are the biggest, takeaways, if you will?
Well, in addition to what you keenly pointed out just on the last slide was, you're not paying your landlord's mortgage. There's a great increase as Bryce just showed. But the key things are you're the homeowner. You can pass it on to your heirs, to a charity, some other family, and let them, when you pass away.
That $350,000 has to go somewhere, right?
Yeah, sign me up.
Yeah.
But aside from the appreciation gain, which is a huge factor, it's also just the touchables, if you will, the tangibles. It tends to provide a more stable life for your family, for you. Traditionally, neighborhoods that have more owner-occupied residents versus tenant-occupied residents tend to have more of a stable price appreciation, mainly because owners tend to keep care of their properties in a way that not all tenants do. And also the huge thing is, it's your place. So you have more independence. If you need to paint the walls or want to paint the walls or put a new window over here just because, hey, it would have been a nice view, you can do it. You don't have to ask the landlord for permission on that stuff.
Yeah. I was thinking, Matt, while you were talking about that, a little while back, I got a rental truck from, Hertz or Alamo, whoever it was. And I was like, man, I'm going to really test this thing out. And so I was squealing tires and, doing 0 to 60 tests, and it was a blast. But it just goes to show that when people own property, I wouldn't do that with my car, right? You probably don't drive your car that way, but when it's someone else's property, anything goes. And I think that just goes to show that the same thing happens when you own a property. You don't hold huge, massive parties where people come in and ruin all your stuff. You treat it like your home and like you're going to be living there for a while. And that's reflected in the neighborhood and, ultimately the feel to the area, I think.
And actually, depending on what type of loan you might be getting, and, Bryce and I can, help you with this once we sit down and meet with you. But depending on the type of loans, lower owner occupancy, especially if it's a condominium, may hinder your ability to purchase it, depending on the HOA finances. But that's a whole nother story. I just wanted to, throw that in there. And the reason why, again, is lenders will look at owner occupancy and planned unit developments and condo complexes.
Mm-hmm. Yeah, good point, man. Okay. Another question that at least I get all the time, that is there less reason to buy now since the new legislation, Tax and Jobs Act came out? What do you think, Matt?
It depends. Everything depends. And, that would be a great thing to talk to your accountant, but false. You still have those great benefits of home ownership. You don't have as much potential tax write-offs, But you still have the equity gain. You still have that pride of ownership and the ability to do things on your own freedom and dime, actually. So
yeah, and going back to the graphic that we had a minute ago, where hey, if you're benefiting 343,000, maybe a year ago it would have been an extra $20,000 in tax benefit, right? But we're talking the difference from 360 down to 340. That doesn't mean that you shouldn't buy a home because you're still 340,000 bucks ahead, right? So it doesn't completely say, hey, this doesn't make sense anymore, right? Okay, another myth, and you may notice that part of what we're trying to do here is dispel, typical myths that people have and misunderstandings. And so another myth is that you need 20% down to buy a home, which is actually not correct. There are many programs out there, a ton of programs out there that allow you to buy a home with much less than 20% down. Oftentimes as little as 1.5%, 3%. A very typical one is the 3.5% down FHA, because you can have your relative gift you money and kind of get creative with how you're coming up with that money. Veterans here, a lot of veterans here in San Diego, they can purchase a home with no money down, up to $650,000 approximately. So that is a huge misunderstanding, but the reality is that most people that are buying a home for the first time are putting down 5 to 10%. So many programs out there, and like I illustrated a few minutes ago with the numbers, putting down 10%, you still can have everything make sense and have it be a very, very ideal situation.
Yeah, and this is great. Let me interject real quick, Bryce.
Yeah.
I just watched a webinar from California Association of Realtors, and I was actually shocked at how many people really thought you needed 20, even 30 or 40% down.
Right.
House. I couldn't believe it, but I guess it's because we're in the industry, we know these things. So again, thanks for joining on this. And on Bryce's slide earlier, he showed the 10% down on his example a couple slides ago. So I mean, again, there are these great opportunities to get in, and we want to dispel these myths for you. So hopefully you can have some new hope again.
Yeah, for sure. And maybe part of that mentality comes from the fact that people hear about having to compete with all cash offers and having to compete with people that have thousands and hundreds of thousands of dollars in the bank. And so maybe they're saying, hey, I got to put down 20, 30, 40% to even compete with those people. What's really the truth to that, Matt?
Well, the truth on cash being king, it's there's an old school thought that, well, I've got all this cash, and a lot of cash investors want to get that cash discount, if you will. And in our current market, it's just it's not really the best opportunity unless someone is really in dire straits that they need to sell fast. Most people that are buying with cash are, again, the investors, and they're looking at one or two things. One, they're a flipper that wants to get a certain net out of it once they invest the money to fix it up and then flip it and sell it. They will have a hard number, and they won't go over typically, even $100 over that. Recently just had a buyer be able to beat out a flipper on a property because of that. Also, if they're looking at rent, they're again looking at what's their return on their investment. Mm-hmm. Whereas I believe I referenced this even earlier, was you as a buyer are looking at it for that long-term potential for investment and also to build your life and build a home for yourself. So you'll have actually more opportunity to outbid these investors because of that.
Yeah. And one thing that I'll just interject here, as a mortgage company, so the reason why sometimes there's that mentality for a cash buyer is that it's almost guaranteed, right? If someone has $500,000 in the bank, they don't have to get approval from anybody to transfer that $500,000 to buy the property, right? It's just almost guaranteed. In mortgages, we can do something very similar where we can actually guarantee the financing part of it. And we can do it with a full underwriting pre-approval, which I think I'm actually going to talk about later. But you can take the chance of the money not coming through off the table, because you can have the underwriter look at it and guarantee that you're approved before actually making an offer. And that's a way where you can actually compete in a situation where you may not be able to compete otherwise with a cash buyer.
And that's really huge. I mean, just having that pre-approval. A lot of people, I mean, even me, when I bought my first house, I'm saying, oh, okay, well, you have enough data. I'm not going to give you everything. And then when I found that house, I was way behind the 8 ball and almost lost the house because of it. So, the things that Bryce does is just incredible, because, he wants to be, I mean, he's putting his name on the line, I'm putting my name on the line, and we're doing it for you. So we want to be sure we say, yes, you can get this. If Bryce says, yes, you can be pre-approved for this purchase price, we want to be sure that you really can. So you move forward, with roses and chariots versus thorns.
Well said, Matt. Love it. Okay, another myth. I only need my down payment when closing a home or foreclosing a home. That is actually false. And the reason being is there are other costs that have to be paid. The big ones are prepaid taxes, prepaid insurance, funding, and an escrow account to pay those expenses down the road. And then on top of that, there are other costs: title, escrow fees, appraisal costs. A good rule of thumb is that you're probably looking at 2 to 2.5% of the purchase price that is you're going to have to pay for closing costs. So if you're going to come in and put a 3% down payment down, you could probably plan on having to come up with 5.5% total. Now, that being said, there are ways that you can have those closing costs paid on your behalf. Quite literally, it could be, working with Matt and having the seller pay you some lender credit, or pay you some seller credit, excuse me. So if the purchase price is $500,000, Matt could help negotiate to get, $5,000 of seller paid closing costs. And that would be a way that you could eliminate or reduce some money out of pocket. Let's see. So one thing I think what this slide is referring to is that a lot of folks, especially that are using the VA benefit to buy a home and doing zero down, you still have to come up with closing costs, right? And those costs still have to be paid. Taxes and insurance still have to be paid. And so, just being aware of it ahead of time, I think, is the key, and knowing that that's going to come up and that you have a plan to work with it. So proactively, what Matt and I both do is when we have a buyer, someone working with us, we talk about where is the money going to come from? How are you going to pay this? And, make sure that we have all of our I's dotted and our T's crossed. But
yeah, Bryce.
Go ahead.
Just real quick on that VA. I have a lot of VA buyers that they hear, well, I can buy money with nothing, and you can't. Except like Bryce was saying, we can get you a credit, either a lender credit or a seller credit towards your closing costs. But a common misconception is you don't need any money in your pocket, and that is actually false. You do need some money, and I can go into this in a lot more detail. So if I start rambling, Bryce, please tell me to shut up.
Keep going, man.
But at the beginning of the day, you get pre-approved, and then we go out and we find a house that's within that price range. You say, oh my gosh, I want this house. So we go back, I give you comps on the property, give you an idea of what the market value is for the property. And then we structure an offer for you, right? So we write down the offer, and then what the seller is going to want to see is that you're putting an initial deposit or an earnest money. Think of earnest money as like you're ante up to get into a poker game or something, right? So you have to have some skin in the game, and that's where you have to have some money in your bank account to be able to put into escrow, which is a neutral third party. I am starting to ramble, so I'll cut it short. But that's your skin in the game. We can get that back, and what that's called is a VA, no money down and no closing costs, but you have to have that money or that tender to get into the game.
Yeah, good point. And like I mentioned a couple minutes ago, I think that especially the VA loan is where there's a lot of misconceptions, just because, what you do hear out, talking to other folks is that you can buy with zero down. And so great points, Matt. And thank you for that clarification. So let's say that someone decides to buy a home and wants to, start the process. What do they do?
You find me, congratulations, and you found Bryce.
High five, boom.
First 2 steps out of the way, right? But seriously, so, you guys have our contact information, reach out to us. Those are the first 2 key steps. You want to be sure you feel comfortable with the person you choose to represent you on what's most likely the highest investment you'll ever make. So then once we meet and you meet with Bryce, he'll ask for W-2s and stuff like that. Again, just to get that pre-approval, not just a pre-qualification letter. It's just really a flimsy sheet of paper that's not even, most sellers aren't even going to take you seriously with that. And then once we get the number from Bryce, that's when we go out and we start looking at the homes. We'll set up your criteria on directly in the MLS and get out there and look at the homes that you're interested in. And don't think that, you're going to, this isn't, what's that HGTV show, Bryce? Home something where they look at 3 homes and they have to choose one. It's not one of those. I used to watch that all the time. And
my wife watches it all the time. So I hear it just subliminally. It's just there, right? So,
I've worked with buyers. I've had one client that we went out one day and that was the home, but I've also worked with people for years. So, it's not a stressful situation. My gain and Bryce's gain is to be sure that you're extremely satisfied with the help that we provide versus closing a deal.
So that's actually a good point. So how long would you say on average it is from the time when someone actually calls you or connects with you to the time when they, close on their home? What would you say on average that would look like start to finish?
Well, I'd say average maybe 2 to 4 months. We might see some changes this next year. I think properties, I'm already seeing properties sitting on the market longer than they have. Some of the thoughts behind that are the higher interest rates, also just the time of the year. But I think you as a buyer are even going to have even more opportunity to, for us to be able to negotiate and get you a better deal. The way things are looking right now anyway.
Cool.
But so, again, it could take a lot longer. The key is that you're happy with the home that we get you. It's not.
Yeah. And I love that, Matt. Both you and I we're not transactional, right? We're not, hey, turn them and burn them, whatever other analogy you want to say. We're about the relationship and doing the right thing for our customer so that ultimately we can get referrals and you can send your friends and family our way. And maybe down the road, we can help you again. And so that's another important point to being here local. We're invested in the community, invested in, the people that we work with, our past clients, and, we do the right thing. We don't force people into things that aren't the right fit for them or that, won't be a benefit long-term.
Right. Well, there's another couple bullet points. I'll just go ahead and you probably already read them while you're listening to us. But yeah, we go out, look for the home, offer, make an offer. I told you a little bit about the earnest money or initial deposit earlier. Then we get the contract accepted. I get that over to Bryce. We open up what's called escrow. It's a neutral third party. Again, we can go into that in detail another time, unless you have questions at the end of this webinar. Bryce and his assistants will go through the underwriting and the processing and get us through there. We'll be communicating with a dozen other entities: escrow, title, the lender, the underwriter, the appraiser, physical inspectors, the other agents, etc., to make sure all this flows smoothly for you. And then the great day is when we get to give you the keys and make that dream a reality. So.
Awesome. Cool. All right. Got another myth. Mentioned and touched on it earlier. I don't need to get pre-qualified, pre-approved to begin shopping. And the truth is, yeah, you do, right? If you don't know what you can qualify for or what you can get approved for, you're really wasting your time and you're wasting everybody else's time too. So it's important to know, hey, if you can only get approved for a home up to $500,000, don't go looking at homes that are worth $1 million and listed for $1 million. It's just a waste of time. And so pre-approved and pre-qualified are the two most common terms that you hear when you're shopping for a home. Pre-qualified is basically just you talking to someone at a mortgage company saying how much you make, how much you earn, what your credit score is, and then being given a letter, right? So like Matt said, it's really not worth very much. Being pre-approved, on the other hand, is where we are actually verifying that you make what you say you make. We are actually pulling your credit report. We're looking at your bank statements, and then we're putting a stamp of approval on a piece of paper with our name on it, certifying that Mr. and Mrs. Smith can qualify and are pre-approved for up to $500,000 or whatever the amount is, right? So definitely, no matter what you do before you go shopping for homes, before you get out in the car with Matt and go start touring homes, get pre-approved because you're going to know exactly what you can qualify for.
Hey, Bryce, I got a quick one for you. It just popped in my head, and it might be popping in our webinee's head too. Does it cost anything? I know they can get pre-qualified online. Again, that's just answering basic questions. But what's the catch? I mean, we've already explained that getting pre-approved is much better. Is there any risk or out-of-pocket expense?
No, and great question, Matt. So no cost whatsoever to get pre-approved. We don't take, what is it that attorneys take? That they take retainers, right? So we don't take retainers up front. We don't have application fees. It literally is your time. So however long it takes for you to track down the documents that we need and fill out a simple client questionnaire, that's the cost. And then we work through it. We get you pre-approved and ready to go to buy the home. But great question, man. One of the common objections that I get is, hey, I had my credit pulled with my bank. I don't want you to pull my credit too. And we were talking about this the other day, you and I, Matt, where I can't remember the regulation. It may be like the Fair Credit Reporting Act, but basically the government has dictated to the credit bureaus that they can't penalize you or ding you if you have your credit report pulled. I think it's 5 times in a 30-day period by the same type of creditor. So in other words, you could go shopping with a couple different mortgage companies and your credit report would come in exactly the same every time, right? So if your score is 740, it's going to come in at 740 with each mortgage company that you shop around with. And then like you mentioned, sometimes it takes a little while to find a property. And so if we have to re-pull your credit again, usually it's not a big issue where it takes you out of the qualifying range. It may drop your credit score by a couple points, but it's not going to be something that will damage and totally, obliterate your credit. Okay.
Yeah, and another great thing about doing this now, I mean, even if you think your credit's not the best, I mean, talk to Bryce, and he can pull your credit and say, okay, well, based on this, let's get you to pay down this or shift some balances from here to here or whatever else to get you in that better position. Because if if he can save you a little bit of interest rate, I mean, that could save you thousands and thousands on the life of the loan. So, I mean, it's definitely never too soon to start that process.
Yeah, no doubt. And I'm glad you mentioned that. I actually had a client a little while back now, maybe a year ago now, where he literally had one credit card, I think. He had one credit card. And he was one of those types of people that when he got a balance, he paid it right back down. He never carried a balance month to month. But on his credit report, it showed that his the balance, because the credit report is just a little snapshot, a little picture in time. So his balance was something like $1,200. Maybe he had gone out and bought a TV, but his maximum credit limit was $1,500. So we ran an analysis and we said, hey, if you pay down that credit card now, we know typically you do it in the next week or two, but pay it down today. And in doing so, your credit is going to go up by 40 points, right? So you paid it down, credit goes up by 40 points. I think it saved him somewhere in the range of, $2,000 to $3,000 up front on his mortgage. So at an interest rate where he would have to pay points and pay a cost, he got it at no points because he was able to improve the credit score. So we can do a lot of things. And like Matt said, the earlier we can get in there and make a plan and help you see and know exactly what you need to do to reach your goal, the better off you're going to be. So once you get pre-approved, we send a pre-approval off to the agent, off to Matt. And then from there you can, meet and go out and look at properties and get really serious.
All right.
All right. Well, moving on. So another myth.
Yeah, and I'm going to start zooming through some of this stuff, and just because I think we're running a little bit low on time, and we value your time for sharing your time with us. So, real quick, so I can save money by working directly with a listing agent or a seller directly. False. You might be able to think you're saving money by working directly with a listing agent or a seller, but you really should have a buyer's agent, because a buyer's agent has a fiduciary responsibility to represent your best interest. If you think about it, the listing agent was hired by the seller with that fiduciary responsibility to get them the highest and best price, right? So they have an instant conflict if you want them to get, to represent your interest to get you the lowest price. So, be careful with that. There are a lot of people, unfortunately, there's a lot of people who say, oh, I can get you the deal, or that's the only way you can get it is if you work with me. But you just need to be, go in with your eyes wide open. Look at the red flags on that, because you might be able to get the house, but at what cost is that going to be at your expense?
Well, and I think not only that, we want you to understand that you don't only negotiate the price up front in a real estate transaction. There are many other things that are negotiated. Repair requests, any other findings in your inspection. There can be a multitude of different things that have to be negotiated. And if you don't really trust the person who's negotiating on your behalf, or if that person is representing the seller too, are your best interests really being, represented? And are you really saving money if that person is not fighting for you the way they would if you were their only client?
Right. And one thing I tend to do is, most of my clients can attest to this, is I tend to talk you out of buying property. I really want to be sure it's really what you want. even clients that are in a time crunch, I'm like, see what you can do to extend your lease and go by month by month or something. Because again, Bryce and I want you to be happy. A happy client is going to introduce us to their friends and family and not feel any pressure on that. And that's exactly what our whole goal is for you to be so outrageously excited with the help we give you. So anyway, next slide.
Awesome. Okay, another myth here.
Is this one mine? Yeah. So listing price is set in stone. False. And we'll start seeing more and more of that. As I mentioned earlier, the market is, we're starting to see properties on the market longer than what we've seen the last few years. So it's also a commodity. So, I can have this sheet of paper right here, and, it's got, act like it's got a $10 gift card on the back, right? I want to sell it to you for $15. Do I have any buyers? Probably not, right? But if I say, do you want this for $1? How many people are going to bid against it to get that extra, that $9 value or whatever? So real estate is a commodity.
Love it.
Thanks. Real estate is a commodity. People, it's not like going into a retail store and, at least in the United States, we don't really have that opportunity to say, I'll pay this much money for this product.
Yeah.
So again, pricing is controlled by supply and demand. And that's why you see some properties on the market for 2 days, because it was priced exceptionally well. And everybody that's in the market has jumped on that property, and that's what bids the price up. If it's overpriced for the condition of the property, it's going to sit there.
Yeah. Very good. Well, cool. I hear this one, and this one actually makes me think of that HGTV show where, what is it, Fix and Flip, where, it seems like a lot of people are excited about buying that fixer-upper that needs a lot of work. Is that always a good idea?
Not always a good idea. There's a lot of unforeseen costs that could be involved. A lot of times, if they're priced cheaper, actually you'll see this, and when we meet, I'll explain more about it. But it's when you see an ultra low price, there's a catch. All right, so maybe there's a foundation issue, or maybe it was an original owner that might have passed away due to their age, and there's a lot of deferred maintenance and stuff like that the family might not want to do any repairs on. So or they just want to get rid of it quickly, so they're pricing it to get it to flippers. But anyway, long story short, it falls. There's a lot of unforeseen costs that might be involved. I don't want to scare you away. I'd be case by case scenario. You see a property, I'll look it up and I'll give you the scoop, so we know if it might be a potential for you or not. Also, it might be very difficult to obtain financing depending on the condition of the property as well.
Yeah, very true. And it's one of those things where, if I don't know about you, but once I get into the property, once we bought our home, it's like, you tend to accept things the way they are, rather than say, I'm going to take some time and redo that or redo this. And, everybody has a busy life. They have other things to do. And, the stuff that you have in mind to get done, may not get done. And so, like you said, it's a conversation that you need to have, and you just need to figure out if it's a good fit or if it's not a good fit.
Right. Excuse me.
Okay, cool. One more myth here, I think.
I love this one. Let me out. This is actually false. Once your offer is accepted, you're not really locked in. So back to when I was saying, you're ante up to get into the game. You put this money into escrow to get your skin in the game. But you're saying, seller, I'm going to buy your house subject to the following. And then we have what's called contingencies or subject tos, right? So you're saying, I'm going to buy the house subject to my investigation rights, my physical inspection. If you want to get a mold inspection, any physical inspection you want on the property, including but not limited to your review and approval of the seller's disclosures, natural hazards disclosures, the property appraising at that value, your ability to get the loan. By default, you have 17 days to do that. And depending on the market or the competition we're going against, I'll probably tell you, well, I think we might have to tighten that up. Or if there's no competition, I'll say, well, let's just leave it at the default timeframes. But again, I'm rambling. So at the end of the day, if there's something you don't like about any discoveries that we find during those investigation periods or contingency periods, then you do have a contractual right to cancel and say, seller, I'm canceling because of, there's an earthquake fault zone that you weren't aware of or something like that. And then you would have contractual right to cancel and get your earnest money back, as long as we do those within the specified timeframes.
Yeah, very good. I actually had a buyer that backed out of a property. This was maybe 2-3 months ago, backed out of a property. She loved the property. It was a great price. But when she looked, Annie's Law, I think it's called Annie's Law, where you find the sexual predators in the area, there were too many, right? And so she didn't feel comfortable. She found another property that fit better, moved in right away, right? So it's all about being comfortable and making sure that, all your boxes are checked, right?
Yeah, and that's another, that's a great point. With the Megan's Law, and also
Megan's Law. Thank you. I thought it was Annie's Law. Megan's Law. You know more about this than I do.
Yeah. So, again, these are important things, and to check on the schools in the area of schools are important to you and stuff like that. But also, I always tell my clients, remember, you're not just buying these four walls, right? You're buying the neighborhood. You're buying your neighbor. You're buying the people that are going to be at the grocery store you stop at on the way home from work. So, you need to look at all of that stuff and not just be in love with those four walls or what's inside of it.
Yeah, so. Very good. Okay, cool. Last thing that we're going to talk about today before our question and answer period is interest rates. That seems to be the first question. What's your interest rate? How do you find the best interest rate? And the answer, there are a lot of answers, but let's talk about them. So number one is we track the interest rate market. So we do our very best to make sure that our clients get the best interest rate possible on the day when they need to lock in. So if you imagine the stock market, interest rates are going up and down every day, right? And so we try to nail in the very best time. Generally, you have to lock in with a purchase agreement. So you need to have an accepted offer before you lock in. There are ways where we can lock you in before you go shopping. And I know that one of the big national lenders is really touting that they can lock you in before you find a home. The bottom line is that you have to take a higher interest rate than what you would have had otherwise. So it's not always the best move for you. It's something we can do if you're ultra sensitive to what rate you get. And, there are cases where you may use that, but in general, most of our clients lock in when they have an accepted offer. Couple other things. So I think we did a look into how many factors affect your interest rate. And some of the big ones are what credit you have. That's probably the biggest. How much money you make, and then how much your down payment is. But in addition to that, there are literally, 40 more different factors that determine exactly what rate you get, right? So what type of property, if you are actually going to live in the property, where the property is located, all those different things go into what interest rate you get. And a lot of the time you'll see different interest rates on the internet, and they may be showing a 2.25 rate. Well, if it's too good to be true, it probably is. But at the same time, it probably doesn't apply perfectly to your scenario. So we look at what rate we can get you, what rate is going to be your best option on the open market. We compare several different options side by side, and then we let you decide. Whatever option feels the best for you, we let you choose. So we're really big into education and making sure that you feel comfortable every step of the way with that. Okay.
Hey Bryce, let me ask you a question real quick also regarding rates. So can you explain a little bit what the difference between your interest rate is and the APR?
Yeah, great question, Matt. And that's a question that I get all the time. So the interest rate is the number or the rate that your mortgage payment is based off of. So it's literally the amount that shows on your mortgage statement after you buy the home. It's the amount that shows on the documents that you signed to get a loan. The APR is a number that looks like an interest rate, but it's not, it doesn't affect your payment. The APR takes into account how much you are paying in closing costs. And so the idea behind APR, which is mandated by the government, is that you could take the APR from one company and compare it to the APR from another company and then say, whichever one is higher is the one where you're paying higher closing costs, and whichever one is lower, you're paying lower closing costs. But the reality is that every company calculates APR differently. The government has not mandated exactly how you calculate APR. And so it makes more sense just to get a complete loan estimate from companies if you're comparing company to company, and then just go line by line. Which one are you paying more at the same interest rate? Compare apples to apples. And that's probably the best way of going about it rather than comparing APR.
That's a great tip. Thank you.
Okay. Well, cool. So I think that takes us to the end. We'd like to take a couple minutes for Q&A. And again, thank you for your time. Thank you for hanging in there with us. We hope you learned quite a bit and look forward to answering some questions here.
Don't be shy. Ask a question.
Okay.
Okay.
Let me think. What would be another typical question that we get from time to time?
Well, I've got a great example. It's not really a question, but I actually had someone reach out to me today, and they saw this property. It's a detached home in El Cajon, listed at $349,000, which is, fine. The market's going to level out, but that's really low for a 3-bedroom, 2-bathroom house. I think it was like 1,400 plus square feet.
Right.
Crazy price. So again, kind of like Bryce was saying with teasers, right? You have these things that just sound too good to be true, and it is. What I did is I pulled it up on the internet. I did some quick comps, again, comparable sales, to see what's happening in that pocket neighborhood. And the lowest price closed, it actually just closed this last week, was for $395, so $50,000 more, and it wasn't even halfway in the same condition as this property. The subject property at $349 being much better condition, that is. So then I looked into a little bit more further detail on it. There's only 4 hours, 2 different time periods for showing and stuff like that. So what that strategy is, when you limit the amount of showing time that someone can look at a house, you've got more people, everybody that's looking at a certain
create some demand.
Exactly. So again, like we're talking about, what is the real estate market being a commodity, that they're creating that demand to drive the price up. Most likely, my guess, unless there's something seriously foundationally wrong with the property that did not show in the pictures, my guess is it's probably going to go for probably $425, maybe even $450, depending on the demand. So
yeah, cool.
What's a question you get a lot?
Well, a question I get a lot is when is the market going to drop? I'm going to buy then. When I want there to be a big crash, and then I'm going to take advantage of it. Do you ever hear that one, Matt?
Oh yeah, but the problem is, when you hear the news report of the crash, it's already on its way back up. I mean, most of the data that we get for sales data, and in the state and everything else, the official public reports are usually a month after that month is closed, because they're compiling all the data and stuff like that. So it's difficult to actually see something that's really current. Oh, a great example is, so when I explained earlier, when I pull comps or comparable sales, if we look at it, if something closed escrow yesterday, okay, so that means a happy home buyer just got their keys yesterday. The market for that property, if it was a typical 30-day escrow, that was actually, we're looking back in history 30 days, because that's when it was picked up by a buyer.
Good point. Okay, it looks like we got a question here. What are some of the better areas of San Diego to look for homes in? What are the up and coming areas where you may be able to get an extra good deal? You'd probably be the one to answer this question, Matt.
Well, again, it depends. What are your motivations? Are you looking as an investment property? Are you looking for residential income, or maybe even a duplex? Especially in San Diego, there's not a lot of neighborhoods that have duplexes and stuff like that. Do you like urban or suburban living? So that would be something best addressed, one, after we know what your pre-approval rate is, because that, a lot of times, especially in San Diego, is going to define what areas we have.
Yeah, very good point. Yeah.
And then after that, that's when we'll sit down. I love to meet with you face to face, so we can say, okay, I usually pull out a map and say, okay, here's some areas. Have you thought about this? Have you thought about this? Depending on your price point. But yeah, I mean, mostly it's, I've worked with people that just want to live in the country and don't want to have any immediate neighbors, and others that, want to be downtown, or like Normal Heights or University Heights, North Park, where, the urban trendiness is too. So it really depends on what you want as an individual.
Cool. Yeah. Good answer, Matt. I think, even if La Jolla and multi-million-dollar homes in Rancho Santa Fe are a good buy, it doesn't really matter if you can't qualify and if you can't afford that type of home, right? So again, it starts with the pre-approval and then talking to Matt so he can analyze things. Okay, last question. Why work with you guys over someone else? So from my perspective, why would someone work with us at Mortgage One? Well, number one is we're here local, and we take responsibility for what we do, right? So we have a great reputation in the local area. We get stuff done on time, and we like to think that we deliver great service doing it. On top of that, we are a smaller company. We're not a big national bank that has lots of overhead and Super Bowl commercials and other things to pay for. And so what does that mean for you? That means that you get a better interest rate on average than what you would get working with a big bank. So on top of the great experience and everything else that we offer, you also get a little bit of benefit in the interest rate game. And that can save you thousands and thousands of dollars over the life of the loan. Matt, how about you? Why would someone work with you over another agent?
Well, why not? No. Or because, how about that? Well, there's a good possibility that we might not mesh. I mean, again, the most important thing is that you feel comfortable with me, and I feel comfortable with you. My client's interest is what's most important to me, making sure that that you're happy. Again, my goal isn't necessarily the money I make when you buy a house. My goal is to make you so happy with me that you want to tell your friends and family about me. And check me out on online if you haven't already Googled us. And get that feeling for yourself. And then I welcome a opportunity to meet with you one-on-one, go over any preliminary questions. Usually my initial meetings with people, it's probably about an hour, because I want to have that time for direct questions and answers, and then also just kind of give you a whole layout of what to expect, for the next steps and moving forward. So.
Okay, cool. Yeah, and just a testimonial, Matt is, to end on this, Matt is an extreme professional and, really does a good job to take care of his clients. And what he's saying here is true. He really wants his client to benefit and to be put into the best situation for them. And I think he's really genuine about that. So reach out to Matt, reach out to myself. We'd love to help you. We'd love to get you started on the process and on the journey to buying a home. But thanks again for your time, and look forward to hearing from you.
Yeah, thanks for joining us. And we're always here to answer any questions. All right. Thank you.